Gold literally just evaporated $53 in less than 3 hours. Yet somehow, 90% of retail traders are out there right now blowing up their accounts trying to catch a falling knife. Welcome to the trading floor. Today, we're breaking down a critical real-time execution plan for spot gold, XAUUSD. I'm stepping in as your chief macro strategist today to dissect exactly what the smart money is doing behind the scenes. We're skipping the fluff and the theory, we are getting straight into pure market mechanics, liquidity flow, and a strict combat execution plan. Look, the price just absolutely plummeted past that 200-day simple moving average, crashing all the way down to a 2-month low of 4,378. And the brutal reality? The reason retail traders are blowing their accounts to pieces right now is that they simply don't understand why this is happening. They're basically stepping in front of a freight train, totally blind to the actual market drivers. Well, let's dive into this and fix that right now.
Seriously, if you're trying to trade in this kind of extreme volatility without a crystal clear understanding of institutional order flow, you're not trading, you're gambling. You need to stop guessing and start executing with a real edge. Before we go any further, check the pinned comment below right now to follow our desk and open an account with a professional broker today. Because surviving these market conditions, it absolutely requires professional tools and flawless execution.
All right, let's completely tear down what I call the macro trap. You know how it goes. Amateur traders see these terrifying headlines: US and Iran tensions escalating, military strikes, geopolitical fear, and they instantly slam the buy button on gold, right? They just assume it's the ultimate safe haven. But here is the smart money reality. Institutions are not fleeing to gold right now. No way. They're actually using these headlines as liquidity to drive the US dollar up, and that is absolutely crushing XAU/USD.
So here's the actual chain of events you need to care about. This is how the real macro drivers work. The US just slapped sanctions on the Persian Gulf Star, which is an agency Iran set up to manage the Strait of Hormuz. In response, Iran's Islamic Revolutionary Guard Corps threatened drastic retaliation. And what does that do? It threatens the global oil supply. Instantly, WTI crude oil jumps 2.35%. But doesn't stop there. The Fed's Austin Goolsbee then stepped in and warned that oil supply shocks make our inflation problems significantly worse. Higher inflation means the market suddenly expects the Federal Reserve to keep interest rates higher for a longer period. That expectation causes the US dollar to aggressively spike, and a spiking dollar is pure, unfiltered poison for gold.
And guys, this next part is absolutely crucial. We've got our ATR trigger staring us right in the face on the economic calendar. ATR, if you don't know, is average true range. It basically measures volatility. Look right here at 7:30 p.m., we have the core PCE price index, which is the Fed's absolute favorite inflation gauge, and it's dropping at the exact same time as the preliminary GDP data. When these numbers hit the wire, the ATR is going to absolutely explode. Market makers are going to use this massive data drop to create insane slippage and sweep whatever retail liquidity is left on the board. Okay, let's jump into the charts and see how this actually plays out, starting with the 4-hour time frame. The primary trend right now is an aggressive, completely undisputed bearish distribution. Notice this widening gap between the blue 50-period EMA and the red 100-period EMA. Price is trading way below these moving averages, just grinding out a relentless sequence of lower highs and lower lows. If price can't reclaim that structure above the 50-period EMA, the path of least resistance is straight down. There's zero structural support for buyers here. Anyone trying to catch this is literally standing in empty space.
Zooming into the 1-hour chart, things get even more obvious. I mean, look at these massive bearish Marabuzu candles. These are thick, solid red bars with virtually no wicks at the bottom. That tells us there's absolutely no price rejection. Buyers aren't stepping in at all. And down at the bottom, look at the volume spiking exactly when the price drops. Surging volume on heavy down candles proves this isn't just a bunch of retail traders panicking. This is highly calculated institutional selling. This is smart money aggressively dumping their positions.
Now dropping down to the 15-minute chart, you can literally see the market makers actively hunting. We've just seen continuous breaks of structure to the downside. What they're doing is sweeping all the sell-side liquidity. Basically, they're triggering all the stop losses of the retail traders who tried to blindly buy the dip earlier. But more importantly, as the price violently drops, it leaves behind these unmitigated order blocks. This specific zone right here, from 4430 to 4440, is now our absolute key resistance zone. Those blocks are going to act like massive magnets for any future price retracements.
Which brings us to the ultimate retail trap, right? Amateurs look at an RSI indicator sitting way down at 32, and they immediately think, oh, it's oversold, it can't possibly go any lower, it is time to buy.
I need you to completely erase that mindset right now. In a massive fund-driven downtrend like this, the professional reality is that an RSI of 32 does not mean buy. It signals extreme, relentless bearish momentum. The sellers have absolute, unyielding control of the tape. Buying an oversold RSI on a market structured like this is just volunteering to be exit liquidity for some hedge fund.
All right, here is your combat execution plan. We are trading what we see with military precision. For scenario 1, our absolute priority is a short. We're targeting an entry at exactly 4432.00. What we're doing is waiting for a weak technical retracement up into the M15 EMA 50 and that key resistance zone order block we just mapped out. Our stop loss goes at $4447.00, which is safely just above the structural high of the drop. Take profit is down at $4390.00, basically riding that impending news pressure downward. That gives us a highly favorable risk-to-reward ratio of about 1 to 2.8. Now for scenario 2, the long scenario. The entry is very simple. Say no to buying. Just do not buy. The market is in total freefall right now. Trying to pick a bottom here is undisciplined gambling. If you buy, you are literally just providing liquidity for the market makers to sell into at a better price.
I really want you to burn this core insight into your mind. The market doesn't move on news, it moves on liquidity and money flow. The news, the Middle East tensions, the oil spikes, the big PCE data dropping tonight, those are just catalysts. The market makers use those catalysts to generate the massive liquidity they need to move billions of dollars. Your job is not to predict the news, your job is to track where the big money is actually flowing and just ride their coattails.
So let's wrap this briefing up with one final warning. Think of the current price of gold right now like a massive boulder just falling off a cliff. The absolute most common mistake retail traders make is standing at the bottom holding out their hands trying to catch it. Don't block the falling rock. Be patient, let it bounce. Wait for that technical retracement up to 44.32, let the smart money reload their shorts and step in right there with them. You have the game plan, now it's time to execute it. Click the link pinned in the comments below right now to follow our desk, get yourself set up with a professional broker and stop being the market's liquidity, trade like a professional. Remember, the data drops at exactly 7:30 p.m. tonight. So, will you be the one hunting the liquidity or will you be the liquidity being hunted? I'll see you on the charts.